And I want to remind, okay, it is recording. So after the meeting, we will be post these videos on our YouTube channels.
So we can only select one on question 2?
Yeah, for now, you know, I probably should have added multiple choices, but it's too late
okay.
now.
Maybe like all of the above, maybe, but
yeah. Good morning, Tim.
Morning. Is this a test or are we ready to take a poll?
In case you need to write it
It
down.
is, yeah, you're ready to take the poll. And let me go ahead and start sharing screen. Do you guys see my screen?
Yep.
No.
So you see the
I can't.
welcome.
Oh, I
You
just
cannot
see
see it?
you. I don't see the screen.
Oh.
Do not see the screen.
On this right now? All right, how about now?
Now we can
Yep.
see it.
Okay, our NorCal CCIM July virtual meeting. Right now, we do have a poll that's been launched. I would love everybody to help us and answering some of these questions. This is going to help us to prepare for our future meetings and also let us know how we can connect with you guys better. I see that we have people start rolling in. We have about close to 30 people, 29 people right now. And 16 people have voted. Thank you so much. So if you just join us right now, please go ahead and select your options on our polling. And I'm going to share the result in just a little bit. I think I'm the only one who gets to see all the results right now live. So great. We have 19 people who had submitted their vote. And I'm just going to wait for another 30 seconds. And then I will end the poll and share the results with all of you guys. All right. 5, 4, 3, 2, 1. Thank you so much for sharing all of your poll. Now I'm going to share results. Are you guys able to see it?
Yes.
Oh, great. So it looks like a lot of people, I was trying to find out, you know, I started to get a lot of questions about like, hey, are we going back to live meetings soon? It is very tough for most people. Everybody wants to see each other's faces, shake your hands, and maybe even giving each other's hug, but it is difficult time. And but it looks like a lot of people prefer to continue to have our monthly virtual meetings or have a quarterly live meetings with the virtual meetings. So this is really good feedback for the leadership team to go back and plan our next year. And then NorCal CCIM events have been, which of the NorCal CCIM events have been most interested to you, which is the monthly meetings like today. That's great because we always have really great keynote speakers, and a monthly mentoring session is just a little bit shorter, but then it is have really good information as well. And then deals and drinks are the ones that we get to share any upcoming listings and also get to network at the end with the breakout sessions. We do have a book club, monthly book club, but definitely hopefully we can have more people to come and join us in the future. And in terms of social media platform, we want to see like what is the best way to connect with our membership. And it looks like a lot of people are on LinkedIn, and actually a lot of people would prefer email. So we will definitely continue to connect with you guys on email. We do have our Facebook page, LinkedIn page, and YouTube page as well. So thank you so much for your poll, like, you know, your participation on our poll. All right, I'm gonna stop sharing right now. And I'm gonna close this out. Well, I want to welcome everybody again back to our Northern California chapter CCIM July virtual meeting. I'm gonna, blow through these slides really quickly, but of course I want to let you guys know a little bit about the agenda. Today we do have a very, very special speaker, Geraldine Serrano from Veracity, and it's going to be moderated by Tim Tikalsky. He is our treasurer as well as our secretary, and we will try to end our meeting promptly at 11 o'clock. And I cannot express enough gratitude towards our sponsors, because especially during this time, if it's not because of sponsors, we won't be able to put together so many events, so many event programs. So I want to say thank you to our platinum sponsors, Sensiba, Filippo, which Tim Tikalsky is one of their CPAs, and he has been giving us a lot of very valuable information during our mentoring sessions. And then also our gold sponsor, Heritage Bank of Commerce, Crexy, Bangor, Chase, and Farmers. We got a new gold sponsors this month, and Farmers Insurance decided to join us, so welcome. And also we have silver sponsors, Business Finance Capital, Chicago Deferred Exchange Company, Mission National Bank, and Redwood Mortgage. And of course, we still have our bronze sponsors, the Private Funding Solution, Novator, IPX Exchange Services, and Rubicon Mortgage Fund, and also our media sponsors, San Francisco Business Times. So hopefully you guys have a chance to subscribe to San Francisco Business Times. Now, I want to introduce a little bit of our chapter leadership team. As you know, Aziz Khatri was our past president last year. I am your current president for 2020. And we have Tim Tran, who is currently our president-elect. And Tim Tikalsky, again, is our treasurer and secretary this year. And Teddy Swain, he's our technology officer. And I want to say thank you to Shane Clark, because Shane Clark has been working tirelessly almost every single week. You see his email, because he's working so hard to put together these programs for all of us, not only the monthly virtual meetings, as well as our monthly mentoring session as well. But we cannot put all these together without our executive director, Terry Shores. He is there making sure everything runs smoothly. And on top of that, we still have other board of directors here who actually been keeping in touch with us. And every single month, we still have our meeting. So just want to let you guys know that on the back end, we are still working really hard to make sure that we provide all these programs for our membership. So now a reminder, every fourth Thursday, so this month will be July 23rd, from 4 to 5, we will have our deals and drinks. This is where you can share all your listings or wants and needs. There is going to be a line. We're going to keep everybody up to 90 seconds to pitch your deal. So you better have a very good elevator pitch for your deals, because the lines can get pretty long, and there are a lot of great transactions out there. And then we're going to break out into different breakout sessions. So you get to do very intimate and small networking. And I cannot tell you, I've been attending these. It's been so fun, because we cannot see each other nowadays, and we do a lot of these webinars, but we don't see their faces. But now we get to do this during our the breakout session. So definitely be sure to join us later this month on July 23rd. We also have our virtual mentoring session. It's going to be this month. It's going to be on July 30th from 10 to 11 a.m. And also we have our monthly book club. So make sure you check your email to attend our monthly book club as well. And it's scheduled for fourth Tuesday of every month. It's early, 8:30, but if you are avid readers, be sure to join, because we definitely want to hear your thoughts and what you have learned from the books that you've read. Now, we need to stay connected, even though we cannot see each other right now at our live meetings. I know everyone is like really desperate, wanting to see each other, but we want to make sure that we still have a platform for you guys to stay connected with us. We want to stay you guys updated on current news, what's going on in our program. So we are on Facebook, we are on LinkedIn, we're also on YouTube. So we record these meetings so that you guys can go back and review them. So make sure you like us, follow us, or subscribe to us, okay? And then we also have this private group, membership group, which is on Facebook. It's called NorCal Members Only Group. This is where we actually do a lot of referrals. You know, if you need somebody, post on there, and then somebody will refer a vendor to you. Or if you have listings that you want to share, be sure to put it on Members Only Group, because this is where we can continue to share things that you may not be able to see outside of the group. So I want to make sure that everybody knows, if you're members, please do join our member only group. So again, CCIM, you all know our CCIM mission statement is to elevate our members to the highest level of success in the commercial real estate profession through education. And that's why we continue to put these programs together. If you are a CCIM, or if you're a member, you should know that you have all these benefits that comes with your membership. So please, you know, take a look at it. If you have any questions about our CCI membership, contact one of us on the leadership team. We can answer all your questions. And I've shared this picture last month. I want to share this picture again, just because I'm so proud of our membership, our leadership, because of our diversity. You know, no matter what your color, your age, your gender, and religion background, we are here with the same goal. Ultimately, we want to share with everybody is that there's no division. We want to erase that division line in any organizations. We want to make sure that we are focusing on our goal of our chapter of our organization, which is providing education, providing the program to everybody. So I am extremely proud because we have a very diverse group here, and that's why we're able to share so many things with each other. And earlier, the poll I shared with you as the main reason is I started to get phone calls, emails to ask me about, hey, when are we going to see each other again? When are we going to have live meetings again? As you know, we had switched this to virtual meetings. Suddenly in March, we just canceled our March meeting pretty much a week or a few days before that because of the coronavirus pandemic. And it is not out of fear, it's not out of weaknesses, it's because we care about you guys. We want everybody, our membership, to be safe, and that is why we decided to do that. And we adapted very quickly, and now we continue. We haven't missed a beat. Every month we're still providing you guys with some programs. So I just want to make sure that you guys continue to follow us even virtually, because we are always here for you guys, okay? And lastly, let's get our program started. Today we have a very interesting program about cost segregation. And this is something that I wanted to learn, I wanted to hear about, because it's extremely important for investors to learn. So I'm going to turn this over back to Tim Tikalsky, who is going to be moderating our session today. Tim?
Thank you, Helen, and thank everybody for attending today. This is an absolute crazy day to be a CPA, as you can probably appreciate. July 14th, which is the day before an extended due date that is unprecedented in my 39-year career. Everything got pushed to July 15th. So would appreciate everybody being on here. And what I want to do is introduce this topic at a 30,000-foot level, and from the perspective of a CPA and advisor who has been actually recommending this tool for probably almost 15 years now. A little historical perspective, this particular technique was not in vogue 15 years ago. It has evolved over several years, primarily because the IRS didn't know how to deal with changes as a result of a cost segregation study. So to set this up, in general, this has been a conversation that I've had with, a typical conversation I've had with real estate clients over the years. Mr. Smith, how are you? You know, what's going on? What did you do last year? Well, I bought a commercial property for $5 million. Great. How much of that property do you think the allocation of that sales price is to land? Well, why do you ask? Well, because, you know, land is not depreciable. We need to determine what the depreciable basis is for the building so that we can take a depreciation deduction. Well, I don't know. What do you think? Well, normally 20% would be a good allocation. So let's say that $4 million is the depreciable basis of the land. Now, or of the building. If this is commercial property, straight line depreciation over 39 years, that will be your depreciation deduction every year for the next 39 years. And 15 years ago, that conversation would have stopped at that point. And there would have been no more technique to accelerate depreciation. In comes several court cases that allow for taxpayers to actually break down that building depreciation, that $4 million, into components that are significantly shorter lives than 39 years. The idea is that when you buy a building, you're buying a bundle of things, not just structural, but non-structural. You have decorative lighting, you have landscaping, parking lots, garbage enclosures for multifamily, pools, all these things that under the code get a shorter useful life and therefore can accelerate the depreciation. And to further enhance this, if you can make an allocation of your costs to tangible personal property, which are typically the ones that have shorter life, you now qualify for, in most cases, bonus depreciation and can actually write off your investment in the year that you purchased it. So this is the technique. This is the 30,000 foot level. This is what people like Geraldine and her company are assisting the clients with, is how do we break down the non-structural components in a way that we can take advantage of the accelerated depreciation. So Geraldine's going to go into the details, but what I would share with you is that this is one of those great ideas that, again, has evolved over time, but I am amazed at how many practitioners and how many real estate investors aren't aware of this and don't take advantage of this. So if you have any questions throughout the presentation, please chat those in. We will monitor the chat. I will let Geraldine go through the details in her presentation, and I will chime in on certain things that I think are appropriate to add. But hopefully your takeaway from this is that this could be a very valuable tool for taking advantage of what I've always said. I love real estate. Real estate, you get to take a deduction for property that's actually appreciating in value. So it's very unique to real estate. And a personal observation, I think a lot of people feel that real estate investors don't pay their fair share of taxes. And primarily because of the ability to make, depreciate property that's appreciating in value. I'm excited at one point to ever see Trump's tax return, quite honestly, because I think that as a real estate investor, he's probably taken advantage of this. And the reason he doesn't want to show his tax return is he probably doesn't pay a lot of taxes because of this technique in general and others. So anyway, I'm going to turn it over to Geraldine and enjoy the presentation.
Thanks, Tim. Let me get my presentation up so that everyone can see it. Where did it go?
There it goes.
Perfect. Okay. Can everyone see my screen? Great. So Tim is right. I'm glad that I'll be able to talk about cost segregation today because not a lot of people, surprisingly, know about it. So for real estate investors, this is a tax strategy that does two things. One, it reduces your tax liability and it improves your cash flow. So everyone wants to know, what is a cost segregation study? It's an engineering study that is an analysis of all the construction or purchasing costs associated with a property. And it classifies these costs on allowable tax rules as either personal property or real property. And personal property includes items such as cabinets, flooring, security systems, certain portions of the electrical and plumbing systems, as well as all land improvements outside the building perimeter, which would include asphalt, concrete, landscaping, wheel stops, bollards. So when we do this type of report, it deals with depreciation expense, which is a non-cash tax deduction taken on all real and personal property. So depreciation expense reduces the net income from a property, thereby reducing the taxable income and reducing the tax payable to the real estate investor. And by doing this, the real estate investor keeps more cash by paying less tax on the rental net income. So let's start with a real world example on how this would work. Let's say an investor purchases an office building in Las Vegas on January 1st, 2019 for $3 million. If this investor does nothing, then this property will be depreciated over 39 years. And as Tim said in the beginning, land's not depreciable. So we're only taking a look at the building. And so it's going to be depreciated over 39 years. And the first year depreciation expense going to be $58,974. If this investor chooses to do cost segregation, then that building is going to be broken out into different asset classes. So we're going to find the assets that not only can be depreciated over 39 years, but we're going to find the assets that can be placed into shorter lives and can be depreciated over 5 and 15 years. And by using this example, if you were to do cost segregation, then you would be looking at a first year depreciation expense of $1.213 million. So the difference between doing cost segregation and not doing it is over $1.1 million. Now, let's look at a different example. If you purchased a building before the date, September 27th of 2017, and this investor bought an office building on December 31st, 2015 for $2 million, then we're looking at a cumulative depreciation expense of $239,402. However, if this investor does cost segregation, then we're looking at a cumulative depreciation expense of $589,345. So that's a difference of $349,944 spread over the first 5 years. Now, why is there a substantial difference between the two examples? And the answer is 100% bonus depreciation, which Tim mentioned earlier. So all personal property purchased or constructed after September 27th, 2017, whether it was new or used, became eligible for 100% bonus depreciation. And what that means is all personal property identified using cost segregations for buildings purchased or constructed after this date are eligible for 100% write-off in the year it was purchased or completed. Before this date, bonus depreciation was available, but only at 50% and only for new assets. So unless you do a cost segregation to identify the personal property, you cannot take bonus depreciation. Therefore, a cost segregation study is essential in order to take advantage of 100% bonus depreciation. So what are the financial effects of doing cost segregation? So the worst case scenario is that the loss created from the excess depreciation expense is carried forward to offset the future net income from rental activity. It can be used to offset income from other rental properties in some cases. Now, for designated real estate professionals, this loss can be used to offset ordinary income, which could wipe out their taxable income for the entire year, depending on the circumstances. But either way, cost segregation will create increased depreciation expense to lower the taxable income and increase the cash flow. And you could see this in the image to the left. So, in summary, cost segregation helps increase the cash flow by keeping cash in the real estate investor's pocket rather than sending it to Uncle Sam. This can be used to invest in more properties. And also, cost segregation saves money on taxes by reducing the current taxable income through increased depreciation expense. And also, cost segregation helps with tax compliance given the new Treasury regulations on the tangible property regulations, which Tim also mentioned earlier. So, if you are a real estate investor and would like to see what the numbers would look like and how much you could reduce your tax liability and improve your cash flow, here is my email address and phone number. I can provide you an estimate at no cost. I'll leave it open to questions.
Let me, can you hear me okay?
I can.
Okay, so let me fill in some gaps here, and I apologize I had to take a call because of the July 15th deadline. So a couple of observations. One is a question I get often is, when do I do a cost segregation study? And Geraldine, I apologize if you went over that, but let's just delve into that for a little bit. So there's two opportunities to do cost segs. Obviously, the obvious one is when you purchase the property or when you complete construction on a project. That will identify the short-lived assets and allow you to not only accelerate the depreciation on the tangible personal property, but to also maybe qualify for bonus depreciation if you can, and write those investments off in the year of sale or the year of completion. But what if you bought this property 10 years ago and you'd never heard of cost segregation, and you didn't have Tim or Geraldine as advisors, and you say, well, gee, did I miss out on opportunity here? I've been depreciating this property over 39 years when I could have been depreciating it much shorter, or even written some off under bonus depreciation, depending on those rules that existed at the time. What do I do? And the answer is, you're not too late. You're actually not too late. What the procedure is that you can have a cost segregation study on property that you purchased years ago, calculate what the depreciation would have been had you done the cost segregation study, and then catch up the depreciation in the year that you have the study commissioned, and take it as a deduction on your return for that year. Now that surprises a lot of people, because normally what they would think is, well, gee, I've got to file an amended return, right? I've got to carry that back, and what about the statute of limitations? So no, over the years, it has evolved that depreciation is actually what's called a method of accounting. And there are procedures in which you can change your method of accounting from a method that was improper to one that is proper. And the procedure by which you do that is called an accounting method change. And so the IRS has rules and procedures that allows you to take that accounting method change and take the additional deductions allowed as a result of that change on a current year return. So an example, let's just say that 10 years ago, I had depreciated this property over 39 years. I find out from a study, cost segregation study, that I was entitled to actually take an additional $200,000 worth of depreciation over the last 10 years. And I was on an improper method. And that $200,000 will be deduction in the year that you do the study. So this was a technique, like I said, every once in a while a great idea comes along. And this is a great idea for tax planning. It's something that can be done after the tax season. So for instance, I'm having conversations with clients right now on how do they reduce their 2019 tax liability. They could simply do a cost segregation study on property that would qualify, and the additional depreciation would be a deduction in their 2019 return. Geraldine, did you have any other comments that you wanted to make on that? Oh, you're on mute.
Okay.
Geraldine,
I just wanted to make sure, or just add that if we do a cost segregation study on property that an investor has, it wasn't a recent purchase, that we will calculate the 481 deduction to show the catch-up depreciation.
Right. And the 481 adjustment is the section she's referring to that allows for that deduction. So that's great. Everybody should be considering that, right? Well, there is a caveat. So cost segregation is so good at accelerating deductions on either current property or property that's been placed in service years ago that you could actually be in a situation where the deduction exceeds the income for the current year, right? That's a possibility. I mean, in the example that I gave, if I had $200,000 worth of depreciation, but my taxable income from the property was only $50,000, I've now generated a $150,000 loss that may or may not be available to offset my other income. So the challenge here is to, before you go off doing a cost segregation study, certainly have Geraldine or a company similar to hers do a calculation of what the benefit would be. But the question is, if that deduction is going to exceed your current income from either this rental property or other rental properties, are you going to be able to take advantage of that deduction? And the answer to that really depends on your status as a real estate investor or a material participant, or I should say, and a material participant in the real estate activities. So to put this in more simple terms, if I am a passive investor in a real estate activity, and let's just give this example of the property that's generating $50,000 of taxable income, but an opportunity to deduct $200,000 of additional depreciation, therefore generating a $150,000 loss. If my status as the investor is simply one of a passive investor, this is the only investment I have, I don't materially participate in this, I don't spend more than 500 hours in the activity, and I'm a doctor or a lawyer or a CPA, somebody that doesn't play in the real estate area, then my chances of being able to take that extra $150,000 deduction are probably negligible. In other words, what that loss will be to you as a passive investor is a passive loss. And while you won't lose the deduction, you will be able to carry that forward against your passive income, either from this particular activity or for future activities. So this is not a great idea for passive investors that have passive income. It is an absolute great idea for somebody who is a real estate professional who actively participates in that property. So let's change the facts. $50,000 net income from this property. I'm a broker, and I clearly am involved in the real estate activities such that I'm going to be a real estate professional under the IRS rules, which means more than 50% of my activity is from real estate related activities, and I spend more than 50% of my time in real estate activities. And with respect to my rental activities, I materially participate in those. I manage them. I spend at least more than 500 hours in managing all of my rental activities. In that case, that $150,000 excess deduction that you generated will likely then be allowed as a deduction against your other income, your W-2 wages, your commissions, your interest and dividends. And if that deduction exceeds all of that income and you now end up with a loss as a real estate professional, you will, under the current environment, be allowed to carry that loss back 5 years on an amended return and recoup tax dollars that you had from previous years. So again, depending on your status, this idea can be very fruitful, or it can be a tempest in a teapot. Because if you're a passive investor and all you've done is accelerated deductions that are going to create passive losses, all you've done is you'll just have those passive losses carrying forward. So very important to establish what your status is. Now, all that I said about passives versus professional, real estate professional, applies only for federal purposes. So our wonderful state of California does not recognize real estate professional. So the losses that are generated in California for the passive activity are going to be deemed de facto passive, and you won't get the advantages that you do on the federal basis. But still, very good benefit.
Thank you, Tim Tikalsky. There are actually other questions on the Q&A, and I know, Geraldine, you already answered some of the questions. Do you want to repeat those questions? Oh, you're muted.
Okay, yeah, I can go through them. So someone had asked, how much does it cost to do cost segregation? And I answered, it depends. Our fee is based on the time it takes to do the study. So it takes into account the size of the building or number of buildings, and how much work it's going to be for us. So to put that into perspective, if we were to be looking at, on the residential side, a 4,000 square foot single family home, it's not going to take us that long to do the inspection and to do the study. However, if we're looking at a 60 million 6-story hotel, the amount of work is going to be greater, so the fee is going to be larger. And again, if you want to get an idea about the numbers, I'm more than happy to provide an estimate at no cost. And then another question was, how long does it take to get the study back? Typically 30 days from the completion of the on-site inspection. However, during tax time, we know that we do get requests where they would need it in a shorter amount of time, and my company is set up to take care of those requests where the study is needed in a shorter amount of time. And then another question is, can cost segregation be done on residential property? It can. However, it cannot be done on a primary residence. And then another question was, who can perform the cost segregation and how do you prove or certify on a tax return? Well, who can do a cost segregation can be someone that is a one-man shop to where you have the top 4 accounting firms. But what you want to look for is someone that is a qualified engineer to do the study, because it is an engineering study. And also you would want to look for a firm that provides what's called an audit defense. So meaning that with my company, at no cost, if the client's ever audited, we will help the CPA with the IRS agent. Another question is, does this work on agriculture properties with trees on it that produces crops? So cost segregation has to deal with buildings. So if there's a building on that property, that's what we would be taking a look at.
So let me fill in a couple of those. So with respect to the fee, every cost seg provider that I've ever employed always does a benefit analysis up front and typically free of charge. That is easily done by presenting to the cost seg provider a depreciation schedule of your property and the address of the property. And they can very quickly come up with a benefit analysis. And no cost seg or even a CPA would recommend that you do a study unless the benefit was way more than the cost. And keep in mind that you're generating deductions from a cost segregation study. These aren't deductions that you're not normally entitled to. This is a time value of money, right? So you're accelerating depreciation deductions that you would get. Again, the example was $4 million property depreciated over 39 years. You're going to get the full write-off of the $4 million, but over 39 years. With a cost segregation study, you're going to take components of that and accelerate the deduction such that the time value of money will then improve your cash flow by a better cash flow after tax. So that's the analysis that's done. And again, the cost segregation providers will probably provide that cost benefit analysis on a net present value basis. So in general terms, and again, I get this question a lot, well, what are the thresholds of which I would do a cost segregation study in general? My experience has been that you need at least, general rule, anywhere from $800,000 to $1 million worth of cost basis in order to justify this time value of money. And also, if you're into the property for more than, say, 15 years, it may not make sense on a net present value basis, especially on a 39-year property. You're halfway through the depreciation already. You're going to get the next 15 years of depreciation. Again, it's time value of money. With respect to the question on, I think there was one regarding, should we do a cost segregation study in the same year that we sell the property? That's a tough one to answer because it really depends on the type of property and how much catch-up depreciation you're going to get as opposed to how much depreciation recapture you're going to have to report in the year of sale. Again, it's a calculation that can be made, but I have done cost segregation studies where we have caught up the depreciation in the year of sale for a property that has been owned for, say, 10 years, taken the catch-up depreciation, and then done a cost segregation study on the replacement property to identify which components of the replacement property actually will receive accelerated depreciation and possibly bonus depreciation. And sometimes the number actually works to your advantage because there is more catch-up depreciation than there is depreciation recapture, depending on the mix of personal property to real property. So that is a technique. What was the other question?
There's another question about, do
Marijuana.
all the items captured in a cost segregation apply to the depreciation recapture when selling the investment asset?
Well, again, tough one to answer, depends on the facts. So you are making an allocation to personal property. And personal property, by its very nature, is subject to depreciation recapture. And again, the recapture basically says, if I sold personal property, I bought personal property for $10,000, and I sold that personal, and I depreciated it fully, $10,000. And 5 years later, I sell that personal property for $5,000. What is my gain? Well, your gain is $5,000. You sold it for $5,000. You have no depreciation, no basis left. And because you took $10,000 of depreciation on it, the entire $5,000 is recaptured as ordinary income. Okay? So it depends on the value of the personal property when you sell it. Now, logically speaking, if I had a piece of property that I bought 10 years ago, personal property, and I paid $10,000 for it, what is that property worth today? It may be $1,000, it may be $0, it may be 10. It really depends on the value of the property. But personal property depreciates economically a lot faster than real property. So the point is, you may not have to recapture, and in my example, the full $10,000. You may only have $5,000 of ordinary income recapture. So it is a calculation that obviously has to be done, and I wouldn't immediately say that, no, it's all got to be recaptured, so therefore it doesn't benefit you. It really depends on the numbers.
Great. Geraldine, I have a question. I think you have answered that question for sure. And also, I actually, from personal experience, just wondering, most of my investment properties are out of state. So is it make more sense to hire a cost segregation company here in California or wherever my investment properties are?
So my company is nationwide. So our people are all across the nation. So my backyard is the Bay Area, and they own properties out of state. So a lot of my clients like how my company has a local presence because they get to, well, not during, during the pandemic it's Zoom, but before the pandemic, they liked how they could, if they wanted to, see me in person.
Great. And will you be able to share your presentation today? We have an audience asking for a copy of that.
Sure.
If you yeah, if you send it to us, we will post it on our website, on our NorCalCCIM.com website, and you can download from there.
Sure. One thing I do want to add, I know Tim had said that he finds the value of doing a cost segregation at 800,000 or $1 million, and with us, we say that 500,000 or less works, especially with 100% bonus depreciation that's in place right now. So I just wanted to make sure that we don't have investors thinking that if it's not 800,000 and above, that cost segregation wouldn't make sense. And again, we provide an estimate at no cost so that you could see what the numbers look like.
Well, and let me qualify that. So I think what I was saying, the 800 to $1 million would be for a property that maybe was placed in service 10 years ago. So in other words, if you're analyzing a property that's old and moldy, that usually is a threshold that works. But I would agree. I'm actually working on an investment scenario right now where a client is looking at purchasing a single family residence for about, I think it's a condo, for about $500,000. And yes, because of the bonus depreciation, generally speaking, Geraldine might have a different opinion, about 30% of a single family home probably could be classified as personal property. And that means that 30% of the investment, in this case, $150,000, would be an immediate write-off for bonus depreciation. So yeah, I would agree that it depends on the facts.
And there's also a question from Shane. If an investment property has over $800,000 of cost basis per Tim's recommendation, should a cost segregation study always be done prior to the purchase of the investment property?
Well, again, we clarified the threshold there. I think that you should always look at whether a cost segregation study is appropriate contemporaneously with the purchase. Again, you don't need to do it before the purchase, although it might be nice to have a little rule of thumb as to how much write-off you would get if you did do a cost seg on this particular property. But the cost seg can always be done with any time after the purchase, as I mentioned, either within the statute of limitations or within the same year or years after. One of my clients' primary tax planning tools was to do a cost segregation study on a property every year. They were generating about $1 million to $2 million of taxable income every year from their properties, mostly multifamily. Hadn't done cost segregations in the past. They said, what can we do? I said, well, let's pick a property, analyze whether or not it makes sense to do a cost seg, find out what the catch-up depreciation is, go for the low-hanging fruit. Let's try for ones that are going to generate about $1 million catch-up, and let's do that property. Zero out the income for that year. Next year, we'll pick another property. We'll do the same thing. For the next 5 years, that's what we did with this client. They had no taxable income for 5 years. Of course, it got into the 6th year. They were out of depreciation. It was like, great, Tim, now what do we do? I said, I don't know.
Buy more properties.
At that point, you've got to buy more property, which is a good segue into, I think, the concept of cost basis. So you need to have remaining cost basis in order for a cost segregation study to make any sense at all. So a question which I'm surprised hasn't been chatted in yet is, well, what if I do a 1031 exchange? Should I do a cost segregation study on a 1031 exchange? Well, again, remember a 1031 exchange, you don't get additional basis from a 1031. The problem with 1031s, they're a great planning strategy to defer taxes, but they are a terrible strategy for generating depreciation deductions unless you put boot into the transaction. So if all I've been doing is rolling over my equity in properties every year, my depreciation basis is going to be my carryover basis from the original relinquished property. So there's not going to be a lot of opportunity to do, accelerate depreciations in a 1031 exchange unless there's boot. So you may have heard me, Helen, and others on this call in previous presentations saying, sometimes it might make sense to just go ahead and pay the tax, sell the property, recognize the gain. Oh my God, that's, Tim, you're recommending that I pay taxes? No, I'm saying recognize the gain, which will be at a maximum federal rate of 20%, maybe 25 with unrecaptured section 1250, do a cost segregation study, and now accelerate bonus depreciation, accelerated depreciation, such that you might be able to wipe out the gain in its entirety and leave a little left over. Would you pay 20% dollars to generate a 37.5% deduction? That's the question I ask my clients. Well, what are you saying? Well, if I sell a property at 100% gain, I'm going to pay tax federal of 20% capital gain rate, or 25. What is the ordinary income bracket? It's 37.5. So I might be able to generate a 37.5% deduction by paying 20 to 25% tax. Does that make sense? So there's a differential there between the ordinary income rate and the capital gain rate. Again, you got to run the numbers. Now, I get the fact that people don't like to pay tax, okay? But when you show them the numbers and say, can I get you to a point of indifference? This is, by the way, this is what CCIM teaches us, right? What is the point of indifference in your investment analysis at the point where after-tax cash flow is equal to the other investment or greater than. And in a 1031 exchange scenario, if you were given the choice of selling the property, not having to go through a 1031 exchange, and then accelerating the deductions such you could offset the gain, wouldn't you be in a better position because you didn't have to, A, be a buyer in a seller's market, identify property in 45 days, you know, all the things that can go wrong with a 1031 exchange. You have time. You could sell the property, find your replacement property, and then do the cost segregation study.
Great. Well, Chris actually has asked if there's any case studies you can share with us. Geraldine, do you have any crazy case studies that you can share with us?
Sure. So we got asked to do a huge portfolio of apartment complexes. I believe it was over 100+ properties across the United States, and we had a 2-month deadline, and we were able to meet it. So
wow,
that's one of many that I
deployed all these people. So I mean, like, so I assume that you work with obviously CPA like Tim Tikalsky, you know, with CPA very closely, and or did you know how much tax they've saved through that practice?
Do you mean on that particular project or in general?
Mm-hmm. For that particular project.
I believe on that particular project, we saved them tens of millions of dollars. I mean, they were a very happy client.
Yeah, for me, I'm always thinking about the cost segregation as well. Especially for the past couple of years, well, actually more than a couple of years, few years, we've been like remodeling our apartment buildings one by one. And I kept saying like, I need to do cost segregation. And then of course time flies and never done it. I'm so glad to hear that I can actually, it's still not too late. I can still do it, but I'm going to take some advice from Tim as well, that I'm going to do maybe one at a time. So I can continue to take that tax benefit every single year.
Right. Yeah, it's a great tax strategy.
Yeah. I have another live example right now that I could share. So I had a client, I'm working on an estate right now that is about $300 million estate. Older couple, husband died, typical scenario, right? And they're generating about $5 million worth of depreciation, or excuse me, of taxable income from these properties. We had done cost segs while the husband was alive, and we had saved them as much taxes as we could. But again, you run out of depreciation, you run out of cost basis, there is no more shelter. Well, in 2019, husband died. What happens when somebody dies? There's a stepped up basis, right? That's how it works. So this property went from basically no cost basis to now a brand new stepped up basis going to the surviving spouse of over $300 million.
Oh my gosh.
Now, even without a cost segregation study, right? If we were to say that 300,000, $300 million, I'm sorry, $300 million of cost basis times 80% would be the depreciable basis. This is commercial property divided by 39 years. We're going to get $6.1 million of straight line depreciation against their $5 million rental income. So that's good in and of itself. But surviving spouse happens to be a real estate professional. They paid a huge amount of taxes in the past years. With a cost segregation study, we're actually going to be able to generate probably an additional $3 or $4 million, at least in the first year of death, such that we are going to generate a loss, which we're going to be able to carry back and get refunds on $3 or $4 million of additional depreciation. So that is going to save them millions of dollars in taxes. and it's just only going to be enhanced by a cost seg. Now, the one caution I have with that, step-up basis, you get the accelerated depreciation, you don't qualify for bonus. So don't get excited about, you know, I'm not going to get a bonus depreciation on $300 million, but I will get the accelerated depreciation when I start to categorize that into 5, 7, 10, 15 years, that type of thing. But so any time that there is an increase in basis, death, buying out a partner, you're in a partnership and a partner wants to get out, and you've been in this property for a while, you have to buy that partner out. The partners will have a stepped up basis, the remaining partners, prime opportunity to do a cost segregation study. Boot in a 1031 exchange, again, stepped up basis, time to do that. Improvements, like you said, good time to look at that. You know, there are other advantages to a cost seg besides the specific depreciation allocation. We're right at the 11 o'clock, I understand. But let me just throw this in. So Geraldine mentioned the, I think the improvement regulations that came out. So when people buy a building, they're buying a roof, right? They're buying, you know, the structural components. What if 5 years after you buy the property, you have to replace the roof? Well, generally speaking, a new roof has to be capitalized and depreciated over 39 years. But here's the problem. You bought the property 5 years ago, it had a roof. Part of the purchase price should be, of the original purchase price, should be allocated to the original roof. I can't depreciate 2 roofs. I shouldn't be depreciating 2 roofs. So I should be writing off the undepreciated basis of the old roof. How do I determine what the undepreciated cost basis of the old roof was? Cost segregation study. And that works for not only roofs, but tenant improvements, right? Ripping out a parking lot, putting in a new parking lot, you know, those things. So if you're going to enter into huge capital improvements and faced with capitalizing those and depreciating those, at least consider writing off the old. That's the point of the cost seg.
That is such a great advice. I mean, I think a lot of us, we all know we need to do cost segregation, but then like somehow a lot of investors just not doing it. So I'm so glad today, you know, we got to talk about this. Geraldine, do you have any other like parting advice before we end this webinar?
If anyone wants to get an estimate at no cost and see what the numbers look like, please give me a call or shoot me an email. And I'm also more happy, and I know we had a limited amount of time, but I'm more than happy to talk about different situations and go into more detail on certain topics that Tim mentioned regarding the 1031 exchange, a step up in basis. But and thank you for having me present today. I really appreciate it.
Absolutely. I think I'm going to be giving you a call. So do you mind to type in your contact number in the chat box so everybody can have your contact information?
Sure.
Great. Well, thank you so much, Tim. Thank you so much, Geraldine. And until next month, I hope everybody will stay safe and healthy. See you later. Bye.
Thank you. Bye-bye.
It's gonna go. Everybody's gone, isn't it?
I don't know.
Not yet. So some people are still here.
Okay.
So. I made a mistake one time for one of my webinars where I was asking the guests to type in their contact and then I just end the meetings right away, right after.
Okay. All right. Well, thanks a lot, Helen.
No, thank you so much, Geraldine. I probably will have to call you to ask you something about my properties too.
Oh, no problem. Give me a call. Good to see you.
Good seeing you too.
Geraldine.
All right. Thanks, guys. Bye.
Bye.